inflation is not coming down. Now, that's the story. That's the narrative. That's what Wall Street likes to talk about because they just want to sell you stocks. So it goes by a couple of names. The first name is the pivot. When would the Fed pivot from rate hikes to rate cuts? That's the infamous pivot. They stopped hiking rates in July 2023. So that is true. They're just on hold for the time being, but they're not even close to a rate cut, and that's what we've been saying. But Wall Street started talking about this 2 years ago. It was the summer of 2022. Remember, the Fed started raising interest rates in March 2022. At the time, rates were zero. When I say rates, we're talking about the Fed funds target rate. So it's a very, really short-term overnight rate. We're not talking about 5-year notes and 10-year notes. Those are different. But the overnight rate that the Fed targets, it was zero at the beginning of March 2022. Well, they just started hiking in March 2022. They finished in July 2023. So about 15 months of rate hikes, and they got it up to 5.5%, which is where it is now. But the Wall Street started talking about the pivot in the fall of 2022. Now, they didn't say it was going to be that month, but they said, early 2023, the Fed's going to cut rates. Well, then that turned into like mid 2023, and then it turned into late 2023, and then it turned into early 2024. Here we are in mid 2024, and they were still talking about it, but they've been wrong for almost 2 years. And we said they were wrong. We didn't say the Fed was going to raise rates, although you can't take that off the table, but we said they were definitely not even close to cutting rates. So what's the kind of backstory on inflation? Inflation peaked in June 2022, 9.1%. And by the way, Matt, let me just do a quick footnote on the definition of inflation. It shouldn't be complicated, but people make it so. When I talk about inflation, I'm talking about the Consumer Price Index, CPI, comes out monthly, computed by the Bureau of Labor Statistics, Consumer Price Index, and it's measured on a year-over-year basis. So you look at the monthly index and you say, what was it a year ago that month? And then that's it. That's how they compute it. Now, that peaked in June 2022 at 9.1%. By the way, the highest since the early 1980s. You got to go back over 40 years to find inflation that bad. But it was 9.1%. By June 2023, so a year later, it had come down to 3%. So, remember after we marched in Baghdad in 2003, that President Bush went to the aircraft carrier and they had that big sign, mission accomplished. Well, the mission was not accomplished. You had basically 2 years of massacres in Iraq between Sunnis and Shia. And finally, the U.S. pretty much got out of there under Obama, well, though we still had bases there. But the Fed was putting up the mission accomplished banner. Well, it wasn't mission accomplished. Yeah, 9.1% down to 3%. Nice job. But it wasn't 2. I mean, they were trying to get to 2. They had what they call the last mile. How do you get that last, little bit down? Well, the problem is it's been going up ever since. So, okay, 3% in June 2023, but by August, it was 3.7. And then in September 2023, it was 3.7. And it's been up and down, 3.2 some months, 3.4. The most recent reading was 3.5. So here we are and that was from March 2024. That data came out in early April. So here we are 9 months, almost 10 months after that low of 3% in June 2023, and it's higher. Inflation is higher than the prior month, the prior 6 months, and at this point, the prior year. So, inflation is not just stuck; it is stuck, but it's actually been going up. And so all you have to do is look at that and say, all right, well, if you're worried about inflation, if that's your job, you're the Federal Reserve, your job is to get inflation under control. And inflation has stopped coming down and is starting to go up. How on earth are you going to cut interest rates? Well, the answer is you're not. You can't do it. So even at the March meeting, Jay Powell was like, well, we've seen good data and we need a little bit more. He said, we're not quite there yet. We're just about there, but we need some confirmation. I think was the word he used. So a couple months like that, and then boom, we're ready to cut rates. They never got the confirmation. It went up. And why was it going up? Well, oil prices were a big contributor. And when oil prices go up, it filters through the whole supply chain. So gas at the pump is an obvious one. By the way, if you go to AAA gas prices, just Google AAA gas prices. AAA has a really good chart, and of course they get their finger on the pulse, and they show regular gasoline nationwide average. Now they can break it down 100 ways, but I just look at regular gasoline nationwide average. That number is higher than it was last week, last month, and last year. It's been going up, of course, just in time for the election. This is not something that Joe Biden particularly wants to see. So, but it's not just gas at the pump. That's the most visible sign. People, they know you pull up at their gas pump and say, price went up again. It's costing more to fill up my Ford F-150 or my SUV or whatever it is. But that price filters into everything you buy because everything involves transportation. In other words, if gasoline's going up, diesel's going up, well, everything moves by truck or train, as the case may be, but mostly trucks. Everything you buy in the store, every loaf of bread, canned goods, fresh vegetables, whatever, it gets there by truck. And if the trucks have to pay more for their diesel, then they have to charge more for the freight, and then someone's going to have to raise the price of goods. So because of the transportation effect, which I just described, and a lot more, airfares, jet fuel, et cetera, the price of oil and the price of refined products, gasoline, kerosene, which is jet fuel, and diesel, go up, and then everything goes up. So that's one of the drivers. It's not the only one, but it's one of them. And how's that going to change in the short run? The two of the three biggest oil suppliers in the world are Russia and Iran. Russia and Saudi Arabia. Russia and Saudi Arabia. U.S. is the other one. Well, Russians and Saudi Arabia, and by extension OPEC, they're called OPEC Plus, are cutting down on production. Now they're fighting a tide. I mean, the world kind of wants to deflate or disinflate. That's what the world wants to do, and that is happening around a lot of the rest of the world. It's not happening in the United States, but there are other reasons for that, including concerns about the geopolitics. Iran just, hijacked a cargo vessel in the Straits of Hormuz. The Houthis have shut down the Suez Canal. The big oil tankers are going around the Cape of Good Hope in South Africa. It's a long way. That the oil is still getting through. I'm not saying that you're not going to be able to get gasoline. I'm just saying that if you add transportation costs and time delays and geopolitical uncertainty and other factors on top of what we've already seen, this is what you get. Now, you can get into some really esoteric discussions. I think they're best avoided because they don't add much. The economists, I always say, when they dream up these things, is because they don't have enough to do. So what I talked about CPI. Well, they invented CPI core. Well, what's CPI core? Well, that's when you take out energy and food, and that's a little more well behaved. Well, thanks, guys. The energy and food is what most people spend most of their money on. So if you can take them out and get a different time series if you want, but that's not what people actually pay. They pay CPI. And then they came up with something called supercore. Well, what's supercore? Well, supercore, you take out food, energy, and housing. Okay, so if you live in a tent and eat canned goods, fine. But those are the three biggest things that people spend money on: food and energy, gas at the pump, food at the grocery store, and housing costs. And then of course the energy price feeds into home heating, air conditioning, whatever you have. This is like 70% of the average household budget, maybe more. And they say, well, we don't count that because we're eggheads. And then take everything I just said, and there's another inflation index called PCE, Personal Consumption Expenditure. That's the one the Fed uses. Same thing, PCE, PCE core, PCE supercore. It's all garbage. I mean, you can compute it. I understand it. I can look at a spreadsheet or an equation and understand it. But I also understand that that's not what people pay. People pay CPI. That affects their attitude towards the economy. That affects their political outlook. That affects everyday behavior. It affects other consumption. If I'm spending more at the gas pump, okay, I have that much less to, go out to dinner or buy a show ticket or, some new clothes or whatever it is. So this has ripple effects that are enormous. Some people, I would say theoretically, you can distinguish between supply side inflation and demand side inflation, and the difference really quickly. Supply side is kind of what we've been talking about. So, oil shipments are reduced. The bottlenecks go back to 2021, 2022 when the supply chain broke down. And there are, concerns about that. economic sanctions coming out of the Ukraine war, new economic sanctions on Iran. Those are all things that affect the supply side. But a funny thing can happen, which is if it persists long enough, it leaches over or spreads over to the demand side. The demand side is psychological. It's people saying, this inflation, it's hanging around longer than we thought. It's getting worse. I was going to buy a new refrigerator in 6 months. Maybe I better buy it now before the price goes up. And then, a new car or, furniture or whatever it might be. I better go get it now before the price goes up. That is a psychological, behavioral factor. But if enough people do it, guess what? Again, you start bidding the price up, the manufacturers can't keep up, et cetera. I think we're in a very dangerous place, meaning the inflation right now, what we just talked about, is coming from the supply side. So that's pretty clear. But at what point, or does it kind of tip over into the demand side? We're starting to see that. We're starting to see pretty good union contracts are getting pretty good raises, and other minimum states are raising minimum wages, et cetera. A lot of that's counterproductive. Certainly, the minimum wage tends to lose jobs, but in the short run, if you have to pay people more, you're going to raise your prices. Somebody went into a McDonald's in California the other day and ordered like a normal meal. I don't know, 12-piece chicken, a Big Mac, whatever, and it was like $25. You don't go to McDonald's to spend $25. You might as well go to a restaurant. But that's how the California minimum wage law is starting to filter through into prices. So it may tip over to the demand side, but in the short run, Wall Street, I'll just wrap up by saying the following, Matt. Wall Street has been wrong for 2 years. By the way, the expectation today is that there may be no rate cuts through the end of the year. I think that's probably right. Certainly not in May, not in June, probably not in July. And then, of course, the Wall Street people, they're always out of touch. They're staring at the screens all day. So they say, yeah, okay, you're right. Not June, not July. So they're going to raise in September. Are you kidding me? The September Fed meeting is 5 weeks before the election. Do you think that the Fed wants to walk into the election buzz off? They cut rates in September after not doing it for last time they cut rates. 2020 was the last time they cut rates. So they don't cut rates for over 4 years. 5 weeks before the election, they cut rates. That is so obviously trying to help, or appears to be helping Biden and hurting Trump. And by the way, right now it looks like Trump's going to win. That's the last thing the Fed wants. The people say that the Fed says we're not political. They are highly political. Trust me. I mean, I've worked with senior Fed officials. I've been partners with former Fed vice chairs. I spent a lot of time with the Fed as a regulatory lawyer. They're highly political. They read the papers, as the saying goes. But so they're not going to cut in September just for political reasons. Then now November, December, if you're just looking at inflation, you're not going to cut. But if you're looking at if we're in a recession, which we may be, that's a separate topic, you may have to cut because of the recession, because of rising unemployment. But the Fed thinks that can't happen, and Wall Street thinks that can't happen. I have news for you. It can happen. It has happened. So what do you call the combination? The Fed's assumption is if unemployment's low, inflation gets high. If unemployment goes up, inflation comes down. That's the Fed's assumption. So they actually don't mind if unemployment goes up a little bit because it'll bring inflation down. But what happens when you have high unemployment and high inflation at the same time? The Fed thinks that can't happen. It has happened. It's called stagflation, stagnant growth with inflation in prices. I lived through it in the late 1970s, early 1980s. I think around the 1979, 1980, unemployment was 10%, but interest rates were 15%. So don't tell me unemployment and interest rates move inversely. Sometimes they do, but sometimes they can both go up together. It's called stagflation, and I see early signs of that. So it's a little bit troubling. But all I can say to our readers and our viewers is Wall Street always gets this wrong. The Fed always gets it wrong. The reason they get it wrong is because their models don't work. Their models are garbage. But the inflation is real. It's going to stick around. But growth seems to be slowing. So we may end up in this kind of stagflationary episode.
Yeah, I think that's what everyone's feeling at home too. They're seeing the numbers, but then when they look and they live their daily lives, they're like, wait, nothing's letting up here with inflation. And it's interesting you talk about the 70s and 80s, because that was a period in time where inflation went up and the Fed tried to stop it. And then all of a sudden they didn't, and it went real high. So we could be in something like that. I want to dive into this because it's a topic that a lot of our viewers are they're asking more questions about it. So I want to dive a little bit further in. And one of the things that you taught me, and I've now repeated it several times in the last month or two, is, what we're seeing here isn't like, I think this is what you've said essentially, is like, this isn't QE, but the government is just spending so much money that's getting into the economy and inflating things. Is that correct? Can you break that theory down? Because the government spending is just off the charts.
Sure. So QE, which doesn't work, by the way, they printed $10 trillion and the economy was flat to down. It was down sharply in 2000, but it was flat for the 10-year period from 2009 to 2019. So coming out of the global financial crisis in 2009 until COVID, which was 2020, but until COVID, 2019, that 10-year period, 2009 to 2019, average annual growth in GDP was 2.2%, 2.2. During the Reagan administration, 1983, 1986, the U.S. economy grew 16% in real terms. That was over 5% a year for 3 straight years. That's growth. That's what the American economy can do. And even if that's not totally sustainable, you should be able to grow 3.25%, 3.5% on a consistent basis. That's what a developed economy should be able to do. So 2.2% is pathetic. I mean, you can get out the pom-poms if you like, but that's really pathetic growth. That's what we had for 10 years. And my view is that the U.S. economy has been in a depression since 2007. And people say, well, wait a second, Jim, recession is 2 consecutive quarters of declining GDP. And that is the rule of thumb. It can last 3 quarters, sometimes longer, but they tend to go 6 to 9 months of declining GDP, 2 or 3 quarters. That's the technical definition of a recession, and it is. And so people say, well, depression must be worse than a recession. So if recession is 2 quarters, the depression must be 10 quarters of declining GDP. And we have not had that. So, but that's not the definition of a depression. A depression doesn't mean continual declines in GDP. It means below trend growth. It means depressed growth. And it was what I was just saying earlier. If growth potential is 3% and you're growing at 2%, that gap between 3% and 2% over time is trillions of dollars of lost growth. So has the economy been growing? Yes. It grew in 2023 and into so far in 2024. But it's depressed growth relative to potential, and that's what a depression is. And if you want an example, just look at Japan. I mean, Japan has been in a depression since 1989. Well, really 1990, December 31st, 1989. They rang the New Year's Eve bell, and then boom, the stock market fell out of bed. It declined, I think, 75%. It just got back. By the way, about a month ago, the Nikkei index just got back to where it was in 1989. So, which is about 40,000. So, nice going, guys. It took you 34 years to recover your meltdown. And that's all they've done is recover it. It hasn't gone up much since then. But Japan has had 9 recessions since 1990, 9 technical recessions. Well, you can chart the recessions, but I call it one long depression. It's a 34-year depression. And I would say the U.S. has been in a depression since 2007. So that's 17 years. We got 17 more years to go. But that's why everyone's out of sorts. That's why real incomes are not going up. That's why income distribution is, the rich get richer, as the saying goes, and they do. And everyday Americans are falling behind, and the middle class is getting wiped out. So, but you can still look for a technical recession within that time series. So, but getting to your point, Matt, QE doesn't work. You talked about government spending and deficits. That's correct. That's fiscal policy. So QE is monetary policy. That's what the Fed does. And deficit spending is fiscal policy. And that's what the Congress does. So let me spend a minute on QE. How does QE actually work? Well, everyone says the Fed's printing money. The Fed's printing money. Well, what's your definition of money? I mean, the Fed has 4 definitions of money. So start there. They have M0, M1, M2, M3. Some people think Bitcoin is money. You get to a point pretty quickly where no one really knows what money is. By the way, I have a chapter on that topic in my new book, which is coming out in November. But So how does QE actually work? How does the Fed print money if that's what they do? Well, the way they do it, they buy bonds from Wall Street. They call up the primary dealers. I used to be, general counsel, one of the biggest primary dealers. They call up the primary dealers and they say, offer me 10-year notes or offer me 5-year notes. So it's your Goldman Sachs or Citibank, whatever. You quote you quote an offer, and the Fed says done. And then the dealer delivers the bonds to the Fed, and the Fed pays for it with money that comes out of thin air. So the Fed gives the money to the dealer to buy the bonds, and that money comes out of thin air. That's M0 based money, printed money. The question is, what does the bank do with the money? The bank just sold the bonds to the Fed. They got paid. What do they do with the money? They give it back to the Fed. They give it back to the Fed as a deposit, something called excess reserves. And the Fed pays them interest. It's the same way you get interest on your bank account. The Fed pays interest. It's called interest on excess reserves, IOER. So all the Fed is doing is building up the balance sheet. The asset side is being built up with bonds. They're buying bonds. And the liability side is being built up with deposits from the banks, which are liabilities from the Fed's point of view. So you're expanding the balance sheet, but the money's not going anywhere. All the QE money, $10 trillion, never went anywhere. They paid the dealers, and the dealers gave it back to the Fed. It was sterilized and never did anything. So was the money printing? Yeah, if you're using M0 to measure, but it didn't do anything for the economy. It doesn't stimulate growth. Ben Bernanke was full of it. Jay Powell's a little more honest. Janet Yellen, she's kind of a affirmative action dunce. They didn't understand any of it, and it definitely did not work. Now, so why is the economy growing? I kind of painted a gloomy picture from the supply side and real incomes and a lot else, but the economy is growing. That shows up in GDP. Why is it growing? The answer is fiscal policy, deficit spending. That's completely different than monetary policy. That works because, well, it works. It works in the short run. It can be inflationary, but it works because when the government spends money, they're giving it to somebody. The money that the Fed created, they give it to the banks give it back. End of story. The money that the Congress spends, the deficit spending, it's going somewhere. It's buying weapons. It's going to, food stamps or welfare or Medicare or Social Security checks or, the Green New Scam or, a lot of it's kind of wasted, but it's going out into the economy. People are getting paid. Corporations are getting paid. They're paying their workers. That money actually does create growth. Now, but there's another problem associated with that. So the short answer is monetary policy doesn't work. It's a joke. We follow it, we report on it, but I'll tell you as an analyst, it's a joke. Fiscal policy does work, but at a very high cost. And here it is. So the U.S. economy in the fourth quarter of 2023, and we're seeing something similar in the first quarter of 2024. We won't have that data for a couple more weeks, but it looks like it's growing about 2.4%, 2.5%, which, it's low compared to potential, but it's decent growth. But how much is the debt going up at the same time? The debt's going up faster. The debt's going up like 3.5% on an annualized basis. So are you running deficits? Yes. Are you getting some growth? Yes. But the debt is going up faster than the growth. And so this shows up in a measurement called debt to GDP. Because people throw around big numbers, and they are big numbers. $37 trillion of national debt. That's about right. But you can't really make sense of that number unless you put it in the context of the size of the economy. I always, simple example. If you owe $20,000 on your MasterCard, is that a lot or not? Well, if you make $20,000 a year, it's a lot. You're probably going bankrupt. If you make $500,000 a year, you can just write a check. And so you can't really learn much from the number, from the size of the debt. You have to compare it to the size of the economy. So what's that number? Well, that number is it's over 130% right now, which, by the way, is the highest in U.S. history. That's a very helpful chart, Matt. That goes back to the late 1960s, so it's a good time frame. The last time, by the way, the number we have today, 130%, a little bit higher, is the highest in U.S. history. The last time it was even close was the end of World War II. It was about 120%. Today, it's about 132%. So it's the highest in history, highest at the end of World War II. But even in World War II, I like to say, well, we won the war. yeah, we spent a lot of money. We ran up a lot of debt, but we won the war with our allies, and the U.S. was a global hegemon. Our percentage of global production, global capacity, automobiles, like whatever, it was off the charts, and we had a long, a long run as the superpower. Today, we've got a higher debt to GDP ratio, but we haven't won any wars lately. We're losing on Ukraine, losing in the Middle East. No one really respects the United States. We've got brain dead leadership, et cetera. So we're not getting anything for our money. We're wasting the money. But it does have that effect I described. But the problem is at lower levels of debt. So let's say the debt to GDP ratio. Look at 1980, for example, 80, 81, around there. It's about 30%. Yeah, it's a really good. Okay, so 81, 30%. So that's when Ronald Reagan was sworn in. The beginning of 1981, he was sworn in. That was the low. That was the lowest since World War II. I said it was 120% at the end of World War II. Yeah, but it was 30% in 1981 when Ronald Reagan was sworn in. So how did you get from 120% to 30%? Because we had a lot of deficits. There were some surpluses, but mostly deficits during that time period. Well, the answer is we grew the economy. The debt went up. It's not that the debt went down. The ratio went down. Even as the debt was going up, the economy was going up faster. So, it's seventh grade math. If you have a numerator and denominator, if the denominator is growing faster, the denominator is GDP. If the denominator is going faster than the debt, then the ratio is going down. What we have now is the opposite, where the numerator is growing faster than the denominator. The debt is growing faster than the economy, which means the ratio is going up. So at a certain level, and by the way, the level is around 90% debt to GDP. So where do we hit? We hit 90%, like around 2012. Yeah, there it is. Okay, 2010. Welcome, Obama. So below 90%, here's what happens. You borrow $1, you spend $1, and you get more than $1 of growth. So you borrow $1, you spend $1, and you get $1.25 of growth. That's actually good. Assuming you don't waste the money, that's a separate issue. But as long as the growth is greater than the debt, then your ratio is going down and your economy is solid. But as you get closer to 90%, that payoff that called the Keynesian multiplier gets smaller. It starts to shrink. So you start out when you're down around we were in the 80s, even the mid 90s. You borrow $1, you spend $1, you get maybe $1.25, but then it's like $1.20 and it's $1.10, and then as you get higher and higher, as you get closer and closer to 90%, it shrinks until you get to a point where you borrow $1, you spend $1, and you get 90 cents of growth. You don't get your dollar back. You don't get the dollar of growth. You get maybe 90 cents. Now, it's still growth. It's still growth. Somebody got paid, somebody got a job, et cetera. But your debt's going up faster. And as it goes up even higher, that multiplier, which is once it goes below 1, you're digging yourself into a hole, but it shrinks very rapidly. In the fourth quarter of 2023, so not that long ago, that multiplier was 0.68, meaning you borrow $1, you spend $1, you only got 68 cents of growth, not even close to $1. I've seen other studies that show it could be as low as 40%. So, okay, so now the debt to GDP ratio is at an all-time high. We're not getting $1 worth of growth for $1 spent, but you're still getting growth. And see, this is the part people don't understand. This is the part the politicians don't bother to explain. They point to the growth figure, say, look, we got some growth, and we did, but they ignored the debt figure. And that's going faster than the growth. So how does that end? So I just described the problem. How does it end? It ends in one of several ways. For most countries, it ends in default. They just default. Argentina is a good example. You can set your watch by Argentinian defaults. They happen like every 10 years, like clockwork. But that's because Argentina, but a lot of other countries as well, they can. We say, why can't they just print the money? Well, the problem is they print pesos, but they borrow in dollars. So if you owe dollars, you can't print the money because you don't have a dollar printing press. You have a peso printing press or any other currency that you want to name. So you can't You can't print the money to pay back the debt because you owe it in a different currency. You owe the debt in dollars, but you print pesos. So that doesn't do you any good. So what do? Well, you just default. Sorry, not paying you. Too bad, banks. Have a nice day. Now, the U.S., so that's usually what happens. The U.S. doesn't have that problem because we can print the money. So I don't expect a U.S. default because we owe $37 trillion. It's like, fine, print up $37 trillion, ship it over. But good luck buying a loaf of bread, because what you do get in that situation is hyperinflation. So there's no reason for the U.S. to default. There's no reason for the U.S. to restructure. We actually can print the money to pay off the debt, but that has consequences, and there are two. One is what I just described, which is really slow growth. The other one is hyperinflation. So right now, and that threshold, by the way, is 90%. That's 90% approximately is where you tip from getting more than a dollar's worth of growth to getting less than a dollar's worth of growth. That's why it's a red line. We're way past that. We're under 37% or somewhere in the mid 130s. We're with who's at our lunch table? Lebanon, Greece, Italy, Japan, the super debtors of the world. That's where we are. So how do you get out of it? Well, in the end, it's hyperinflation, but not right away. I'm not saying hyperinflation tomorrow or next month or next year. What you really get is slow growth. It's just a slow grind down. The rich get richer, the middle class gets demolished. Younger people can't afford, can't save, they're stuck in their parents' homes, can't get their own homes. Investment dries up, productivity declines, and you get this just slow growth, occasional recession stage that lasts for a long time. And again, Japan is the example. Japan's the model of this. We are Japan. So this is why I say we've been in a depression since 2007. We're in this slow growth phase. It's getting worse. But if somebody says, hey, Jim, we had 2.6% growth in in the fourth quarter of 2024, where's the recession? Or sorry, 2023, where's the recession? I'll say, well, it's coming. But the problem is you got that growth by borrowing more than you grew.
Yeah. A number that's been swirled around in the paradigm offices is that 130% debt to GDP. I believe 51 out of 52 countries that have ever hit that level have defaulted. And the only outlier is Japan. And like you said, they had 34 years of just nothing. So
right.
It's a very bad number as a country to hit. So I completely agree with you. The other thing I want to dig into...
Sorry to interrupt, but the reason Japan and the U.S. is the best model, the best way to understand the U.S., Japan is a country that borrows in a currency it prints. Japan's debt is in yen, Japanese yen, and they print yen. The U.S. debt is in dollars, and we print dollars. So if your debt's in the currency you print, you're not going to default, but you are going to walk into hyperinflation.
Yeah, this is why we like it. You're deep in the weeds, and you know exactly what you're saying here, and that's 51 out of 52 is the real number. And if you're printing your own currency, you're not going to default. Okay, one more into the weeds question on what you just said too. The rich getting richer, the middle class getting erased. Is it as simple? When I think about it, it's terrifying because the government is spending all this money. And if you think about how the government spends money other than 2020 stimulus, right? Here you go, people, have $1,200.
Right.
The way they spend money, it starts at the powerful, rich, related elites. That the money is just going directly to them because I'm making it up, but like Joe Biden's third cousin owns a construction company. It's like, hey, the government's going to increase the budget on building spending. Give it to the third cousin. That guy gets richer, and the money never ends up in the middle. It's gone.
Well, first of all, you're not making it up. That's exactly right. That's exactly what's going on. And to just kind of explain that, there's an old joke, but I'll tell it just because it's funny if you haven't heard it, but it's actually true. So there's the old joke. There's 100 guys in the bar, and Bill Gates walks in, and on average, everyone's a billionaire. But there's actually only one billionaire in the room. His name is Bill Gates. Everyone else is just having a beer. So the point being, almost all the government statistics, not all of them, but almost all of them, are averages. Okay, it's information. You can do trends. You can do all your analysis, your regressions, and all that stuff. But averages hide as much as they tell you. They tell you something, but they hide a lot. And what they hide is called the degree distribution, meaning an average of what? What is any average? Well, it's a bunch of numbers, add them up, divide by the number of numbers, and that's the average. Okay. Um, so when you see unemployment or you see CPI or you see real wage increases, et cetera, or, I'm going to say CPI or inflation number or a lot else, those are averages. Well, what's in the average? Let's just take CPI, for example. I mean, you have to be a geek like me, but go to the Bureau of Labor Statistics and look at the press release and look at the calculation. So that the CPI might be the Commerce Department, but I said Bureau of Labor Statistics. But the Commerce Department, it's a government website. It's easy to find. Well, in that CPI calculation, there are 100 or so subcomponents. Big ones like gasoline, but eggs, bread, butter, clothing, automobiles, furniture, and even broken down more finely than that. And some of them are going up, some of them are going down. That's normal. But you have to look at that. But so when it comes to income, people say real wages went up by whatever 1%. Nominal wage increase minus inflation. Real wages went up 1%. Sounds good. It's not a lot actually, but sounds good. But what you discover is that some people their real wages are soaring, and everyone else is falling behind. So the average may be up 1%, but when you look at the degree distribution, you say, okay, what are the top 10% making? How's the bottom 10% doing? What about the middle? 60%. How are they doing? You can even break it down. Like you say, 10% brackets or whatever, and look at each bracket separately. And then break it out further. But what's happening in urban areas, rural areas, et cetera. Again, I'm down in the weeds, but my point is, while the average may be kind of okay, the degree distribution is awful. All of that money is going to a lot of it to stockholders, CEOs, government officials, and some tech entrepreneurs, et cetera. It's all good, but that's a relatively small slice. Whereas everyday Americans, blue collar workers, small business owners, restaurant workers, healthcare workers, nurses, et cetera, they're just struggling. I mean, they might be getting a raise here and there, but it's not much. And then when you subtract inflation, it might be negative. So the only caution I would drop, Matt, is that the numbers aren't great. They're like okay, but the reality is worse, because when you go behind the average to look at how it's distributed between the rich and everybody else, you'll find that so much of that is going to the rich. Again, CEOs, stockholders, money managers, defense contractors, government officials, Nancy Pelosi, a small slice, and everyone else is being left behind. And that's why there's so much discontent. Biden, I mean, I had difficulty attributing anything to Biden because he's so cognitively impaired right now. He doesn't know where he is. I don't know if you saw the clip of him in the Wawa the other day. By the way, I live in New England, but I kind of grew up and spent a lot of time. My family still lives in the mid-Atlantic states, New Jersey, where I went to high school, Baltimore, where I went to college, went to law school in Pennsylvania. So I know that area pretty well. And they have this store called Wawa. But if you say that, and they're great, they're great stores. But if you say that to anybody anywhere else in the country, they're like, "What are you talking about? Is that like a Native American tribe or whatever?" So Trump the other day, Trump can't leave New York because he's on trial, in a criminal trial. You have to show up. You can't just wander around. So, but he's been campaigning in New York City, which is about as blue as you can get. And the other day he went to a bodega in the Bronx, and they loved him. He went to a couple of bodegas, and they loved him. They're like, "Oh, Mr. President, Donald Trump, yay!" And by the way, these are Black and Hispanic voters. Those are the people who live in these areas who Trump's visiting and go to the bodegas. Jill Biden, by the way, Dr. Jill Biden gave a speech a couple of years ago, and she said bodega. And I was like, what the heck's bodega? But I realized that she couldn't pronounce bodega, which is, Spanish. That's how you say it. But I was like, man, I don't know what you got your PhD in, but it wasn't linguistics. So she's like, the bodegas. I'm like, what? But that shows you how kind of out of touch the Bidens are. So, but anyway, this campaign visit for Trump was a big success, and and the Biden campaign's freaking out. They're like, wait a second, blacks and Hispanics are coming to Trump, and they are. That shows up, particularly black men and Hispanics across the board. That shows up in the numbers. So the Biden campaign said, well, we'll do the same thing. Well, so they go to a Wawa. First of all, Wawa is not a bodega. They're nice stores. I shop at one when I visit my family down in Cape May, uh, but they're kind of large. They're not particularly crowded. They got a fresh food section, a deli, whatever. But they're not bodegas. Bodegas, if you go to, I went to one in where was I? Miami, and it was late at night. And I needed something. I just went into one, and it was the aisle was so narrow that only one person could go in the aisle at a time because it wasn't one for two people to pass each other, and the stuff was piled high. That's a bodega. No, but Wawas are kind of big, and but they actually had a rehearsal. The employees rehearsed what they were going to do when the president came in. Nobody was in the place, I guess, for security reasons. Okay, well, you need security, but in a big store that's empty, it's not exactly a crowd that's trying to hug you and say, "Way to go, Donald Trump." This is like it was completely empty. It looked like a Twilight Zone episode. And then Biden had his tip in his hand in advance because he couldn't do the math or like reach in his pocket and make a tip. They had to like put it in his hand and say, "Mr. President, here's your tip." And it was just the whole thing was pathetic. But the point is, that's how these campaigns are playing out. No, I mean the Biden administration doesn't have a clue. They don't understand anything we've been talking about on this interview. So it's pretty bad.
Yeah, zero touch with the actual middle class. And that's
right.
true. So one last thing, and I'll drop it, even though this is where I'm laser focused, because I think this is the number one threat to Americans in the middle class, and they don't know it. What can someone in the middle class that's like, uh-oh, I'm about to get erased. There's tons of money being printed. It's not making America more productive by each dollar, and it's going to politician and Wall Street's best friends and not me.
Right.
What can they do? What's like the number one investment they could do, or number one way of thinking about it? What could someone do right now?
Well, this is going to sound obvious, Matt, but people actually, you say it, and people roll their eyes and go, "I know that," but they actually kind of don't. It's diversification. Now, I'm not going to go through the economic theory of diversification. It actually works to get higher returns with less risk or the same risk. But people don't understand what diversification is. They say, "Oh, I'm diversified. I own 50 different stocks in 10 different sectors. Semiconductors, minerals and mining, retail, consumer, discretionary spending. I own 50 stocks in 10 sectors. I'm fully diversified." And I say, "No, you're not. You may have 50 stocks in 10 sectors, but you have one asset class. It's called equities or stocks or whatever you want to call it. You have one asset class. You're not diversified at all. You're all in the stock market." And in normal times when you don't need protection, they do behave idiosyncratically. But in stressful times, in a financial panic or monetary panic, they all correlate. They all go down together, and you lose a lot. You lose 40% of your net worth or whatever's in your investable assets. Real diversification, you can have stocks. There's a place for stocks, but have some cash, have some real estate, have some gold or silver, precious metals, have some alternatives. If you have a slice of each one of those, that's real diversification. Those asset classes do not correlate to a high degree in financial stress. So that's the answer. So let's just take stocks. I'm not saying get out of the stock market. I'm saying I would dial down my equity exposure. And then maybe if you're 80% in stocks, it might be smart to go to 40%. And then within the stocks you pick, what's going to perform well? Well, it's pretty clear defense stocks are going to do well because the U.S. is behind the eight ball in a couple of different wars, and we're going to have to bring up our game a lot. And they're going to have to spend more money in defense. The U.S. might as well just fold up its tent and go home. Healthcare, driven by demographics to a great extent. Natural resources, oil. Oil's been beaten down by this Green New Scam. The Biden administration is just completely hostile to oil and natural gas. I'm sorry, you're not getting away from oil and natural gas. First of all, the Green New Scam is a scam. The science is very clear. Not only does CO2 not cause global warming, it's the opposite. If you have a global warming trend, that causes more CO2 to be released. But the scammers, the green scammers, have it backwards. They're like CO2 causes climate change. No, it's like climate change causes CO2 releases, but it's not harmful in any way. It's a trace gas. Scientists can't even figure out what it does, except it's plant food. Plants inhale CO2 and produce oxygen. We inhale oxygen and produce CO2. It's a nice virtuous circle. You get rid of enough CO2, the plants are going to die, and then we're going to die. There's a lot more to climate science than that. I mean, if there is a slight warming trend, it might be cooling at this point, by the way, but to the extent there was any warming, which is very slight, it's caused by solar cycles, volcanoes, ocean currents, and clouds. Clouds are actually the biggest factor. I'm not talking about CO2 clouds or emissions. I'm talking about just humidity in the air. Water droplets would be a more technical name. So, but what's the Biden administration doing? They're in their misnamed fraudulent Inflation Reduction Act. The Inflation Reduction Act that Nancy Pelosi ran through in 2022, August 2022, was actually the Green New Scam. It was AOC's, Green New Scam. It took a couple of years to get it done, but that's what it was. And there's $1 billion, about 900, almost $1 trillion. I misspoke. About $900 billion allocated to Green New Scam projects. Goes back to what you were saying earlier, Matt. If you're an insider, you're like Nancy Pelosi or her husband Paul. If you know that's coming because you're the one writing the legislation, you go out and buy the stock. That's one way to be worth 25, 30 million on a government salary. And all the Congress are in on that. It's all wasted money. It's all very damaging to the economy. It's not actually a problem. It's a fake problem, but people can make an awful lot of money out of it. But so that means oil and gas are not going away. They've been beaten down because of the Green New Scam propaganda. So that's a very attractive sector. So I would say oil, natural gas, defense stocks, healthcare are areas that will do well. But I would dial down my overall equity exposure. 40% seems a lot more comfortable than 80% given what's coming. So this is going to sound really boring, but you know what? If you go to a good bank in your neighborhood and get a CD, they're paying 5%. People would go back to the 10 years we talked about, 2009 to 2019. The banks were paying practically zero, maybe a quarter of 1%. You're like, we got to be an idiot to put your money in the bank because they're not paying anything. Go get some stocks or whatever. Well, there are reasons to have cash anyway for protection, diversification, liquidity in a crisis, etc. But the critics were right. They weren't paying you anything. Today they are. Now you have to get a CD. CD, you might lock your money up for a year. So it's not like a checking account. Mm-hmm. So don't put any money into a CD unless you can wait a year, 6 months or a year, whatever it is, because you're not going to be able to get it back without paying a penalty. But assuming you have the cash and you want the cash and you don't plan to spend it in the near term, go get a 1-year CD. They're paying close to 5%. Stocks are yielding about 3% in terms of dividends. So cash is outperforming dividends today. So, you put in $100,000, you come back a year later, you got $105,000. You didn't have to lift a finger. So that's attractive. Gold, what can I say? It's up 30% in the last 3 months. I expect that to continue. So we can, we've done a lot on gold in the past, but for geopolitical reasons, it's obviously a good inflation hedge. But gold is more than that. We're calling in our publications, Matt, we're calling gold the everything hedge. Does it protect you against inflation? Yes, it does. But it also protects you against war, geopolitical risk, financial meltdowns, and a lot else. So gold's the everything hedge. People are starting to realize that. And like I say, it's up 30% in the last 3 months. And then some real estate. Now, not commercial real estate. I think commercial real estate has not hit bottom, but farms, income producing real estate, just buy a bigger house, put an addition on your house. Don't over leverage it, but that's something you can sit on, and that will pay off over the year. So that's, stocks. Oh, treasury notes. Treasury notes are, first of all, yielding. 10-year treasury notes are yielding close to 5%, not quite. I think about 4.6%. The 5-year